Welcome to Market Meridian, your daily source for fast, accurate global financial news. I'm Eric, your host today. In a historic moment that has sent shockwaves through the global financial system, crude oil prices have officially breached the $100 per barrel mark, a threshold not seen since the early days of the Russia-Ukraine conflict in 2022. This dramatic surge is not a random market fluctuation but a direct consequence of escalating geopolitical tensions in the Middle East, where growing instability has cast a shadow over one of the world's most critical energy supply arteries, the Strait of Hormuz. As the crisis unfolds, the ripple effects are being felt across every corner of the global economy, from inflation outlooks and business operations to financial markets and energy policy, with uncertainty mounting about how long the volatility will persist. The latest price rally began in late February 2026, following joint air strikes by the United States and Israel on Iran, a move that shattered the fragile balance of power in the Middle East and triggered widespread concerns about oil supply disruptions. Since then, Brent crude futures have gyrated wildly, at one point soaring to within a whisker of $120 per barrel before easing slightly, while WTI crude has similarly surged past the $100 threshold, marking a decisive shift in the global energy landscape. As of March 13, 2026, China's crude oil main contract, SC, was trading at 754.1 yuan, representing an 8.07% gain with a high of 778 yuan, reflecting the global upward momentum in oil prices. The core driver of this surge is the growing threat to the Strait of Hormuz, a narrow waterway through which approximately 20 million barrels of crude oil and oil products transited daily in 2025, accounting for around 25% of the world's seaborne oil trade. Recent statements from regional powers have raised serious doubts about the safety of this vital shipping lane, with attacks on oil infrastructure and the cessation of tanker traffic pushing supply concerns to the forefront. According to the International Energy Agency, IEA, a March 2026 oil market report, the conflict in the Middle East has created the largest supply disruption in the history of the global oil market, with crude and oil product flows through the Strait of Hormuz plunging to a trickle from pre-conflict levels. Gulf countries have already cut total oil production by at least 10 million barrels per day, MBED, and with limited capacity to bypass the strait and storage facilities filling up, supply losses are set to increase if the crisis persists. Global oil supply is projected to plunge by 8 million barrels per day in March 2026, with curtailments in the Middle East only partially offset by higher output from non-OPEC Plus producers such as Kazakhstan and Russia, which have recovered from earlier disruptions. This supply crunch has been compounded by the shutdown of more than 3 million barrels per day of refining capacity in the Middle East due to attacks and a lack of viable export outlets, further tightening global fuel supplies. The impact of the $100 oil price has been immediate and far-reaching, forcing economists worldwide to revise their inflation outlooks. According to estimates from Capital Economics and Goldman Sachs, a sustained rise in Brent crude to $100 per barrel could push global average inflation up by 0.6 to 0.7 percentage points, equivalent to an invisible tax on the global economy as energy costs embed themselves into nearly every product and service supply chain. This inflationary pressure is already manifesting in consumer prices, with U.S. gasoline prices rising by approximately 16% in a single week, pushing the average price of regular gasoline to $3.45 per gallon, with experts warning that prices in California could exceed $8 per gallon by the end of the year if tensions persist. For households, this means higher costs at the pump, which erodes disposable income and suppresses consumer spending on other goods and services. For businesses, the impact is even more acute, particularly for energy-intensive sectors such as aviation, transportation, manufacturing, and chemicals. Logistics companies have been hit particularly hard, with fuel accounting for approximately 30% of their operating costs. For example, the cost of shipping 15 tons of goods from Shandong to Henan in China has increased by 18% in recent weeks, while global tanker rents have skyrocketed from $130,000 per day to $400,000 per day due to the disruption in the Strait of Hormuz. This has translated into higher costs for imported goods, with the price of imported soybeans expected to rise by 15% to 30% as a result of increased shipping costs. The agricultural sector is also facing indirect pressure, as the Middle East is a major global hub for fertilizer production. Iran, the world's second-largest exporter of urea, has seen its supply disrupted, pushing urea futures prices above $530 per ton and increasing costs for agricultural powerhouses like Brazil and India, where 80% of fertilizers are imported. This could lead to reduced fertilizer use, lower crop yields, and ultimately higher global food prices in the coming months. Financial markets have responded to the oil price surge with heightened volatility, creating a stark divide between energy stocks and sectors dependent on cheap fuel. In Hong Kong's stock market, energy giants have seen strong buying interest, with China National Offshore Oil Corporation, 00883, closing at 29 Hong Kong dollars and 10 cents on March 12, up 3.7% from the previous day, and China Shenhua Energy, 01088, rising to 48 Hong Kong dollars and 46 cents, a 1.6% gain. Other energy stocks, including CNOOC Limited and Yangzhou Coal Energy, have also posted solid gains as investors bet on higher oil and gas prices boosting their profitability. Conversely, sectors such as aviation, airlines, and consumer discretionary have come under significant pressure. Airlines, which rely heavily on jet fuel, are facing soaring operational costs, with many already warning of reduced profits or potential fare increases to offset the burden. Similarly, chemical companies that use crude oil as a raw material are grappling with higher input costs, with major brands like Procter & Gamble and Unilever announcing plans to raise retail prices for detergents, shampoos, and other household products by 3% to 8%. In response to the crisis, major global energy agencies and governments have swung into action. On March 11, 2026, the 32 member countries of the IEA unanimously agreed to release 400 million barrels of oil from their emergency reserves, the largest collective stock release in the agency's history, to address supply disruption stemming from the Middle East conflict. IEA member countries hold more than 1.2 billion barrels of emergency stockpiles, with an additional 600 million barrels of industry stocks held under government obligation, providing a significant buffer against short-term supply shocks. The IEA has also stated that it is closely monitoring global oil and gas markets and stands ready to coordinate additional emergency measures if supply chains face further disruption. Meanwhile, governments in Japan, India, and Europe have announced plans to release their own strategic reserves or implement energy conservation measures to mitigate the impact of higher oil prices. For investors, the oil rally is more than just a commodity story. It is a clear signal that inflation risks and economic uncertainty are back in the spotlight, reshaping investment strategies worldwide. The market has already adjusted its expectations for central bank policy, with the probability of interest rate cuts by the U.S. Federal Reserve in 2026 being revised downward from 60 basis points to approximately 35 basis points. If oil prices remain elevated, central banks may be forced to delay rate cuts or even adopt a more hawkish stance to combat inflation, which would further weigh on economic growth. This has led to a shift toward stagflation trading in financial markets, where investors are balancing concerns about slowing economic growth with rising inflation, a dynamic that has made traditional safe haven assets like gold more volatile. Looking ahead to the next 24 hours, the trajectory of oil prices will be largely determined by three key factors: geopolitical developments in the Middle East, updates on IEA emergency reserve releases, and market sentiment. Here's a detailed forecast of what to expect. First, geopolitical tensions will remain the primary driver of price movements. Investors will closely monitor statements from US, Israeli, and Iranian officials for any signs of de-escalation or further escalation. If there are reports of additional attacks on oil infrastructure or a complete closure of the Strait of Hormuz, Brent crude could surge back toward $110 per barrel, with WTI crude likely to follow suit. Conversely, any hint of diplomatic negotiations or a temporary ceasefire could trigger a short-term pullback, with prices potentially easing to $95 to $98 per barrel. Market participants will also be watching for updates on U.S. policy, particularly whether the government will follow through on hints of temporarily easing oil-related sanctions on Iran to stabilize supply. Second, updates on the implementation of the IEA's emergency reserve release will be critical. The IEA is expected to provide further details on how the 400 million barrels will be distributed across member countries and the timeline for release in the next 24 hours. If the release is faster or larger than expected, it could ease supply concerns and put downward pressure on prices. However, given the scale of the supply disruption in the Middle East, with daily oil flows through the Strait of Hormuz down 90%, the impact of the reserve release may be limited, providing only a temporary reprieve from price gains. Market participants will also be monitoring stock levels in major economies, with global observed oil stocks at 8,210 million barrels in January 2026, the highest level since February 2021, providing some buffer against short-term supply shocks. Third, financial market sentiment and technical factors will play a role in short-term price movements. The recent volatility in oil prices has led to high levels of speculative activity, with hedge funds holding large short positions that could trigger a short squeeze if prices rise further. Additionally, technical resistance levels around $105 per barrel for Brent crude and $102 per barrel for WTI crude will be closely watched. Breaking these levels could trigger further buying momentum, while a failure to break them may lead to a pullback. Equity markets will also influence oil prices, with a rebound in global stocks potentially boosting risk appetite and supporting oil prices, while a sell-off could lead to profit-taking in commodity markets. In terms of sector-specific impacts over the next 24 hours, energy stocks are likely to remain supported by elevated oil prices, with companies involved in oil exploration, production, and refining expected to see continued buying interest. Conversely, airline and transportation stocks may face further pressure as investors price in higher fuel costs. For currencies, the US dollar could strengthen slightly as investors seek safe haven assets, while currencies of oil-importing emerging markets, such as the Indian rupee and the Turkish lira, may come under pressure due to increased import costs. Gold prices are likely to remain volatile, as investors balance inflation hedging with concerns about higher interest rates. The longer-term outlook for oil prices remains highly uncertain and will depend on the duration of the Middle East conflict and the extent of supply disruptions. If the conflict escalates and the Strait of Hormuz remains closed, oil prices could rise to $120 per barrel or higher, triggering a more severe global economic slowdown. However, if tensions de-escalate and supply chains are restored, prices could gradually ease back to $80 to $90 per barrel by the end of 2026. For now, the global economy is facing a critical test, with businesses, governments, and investors all grappling with the fallout from the $100 oil price and the geopolitical crisis that triggered it. At Market Meridian, we will continue to monitor this developing situation closely, bringing you every critical update as it happens. Whether it's breaking news on geopolitical tensions, changes in oil supply and demand, or updates from central banks and energy agencies, we are committed to keeping you ahead of the markets and providing the insights you need to make informed decisions. Subscribe my channel and give me a big thumb. Thank you.